Hi everybody, welcome to today's discussion about what's happening in property markets and ways in which investor owners can offset the impact of rising interest rates. With me today is Tyron Hyde, Director of Washington Brown, the nation's leading experts on depreciation, which is one of those methods by which investor owners can improve their bottom line in times of higher finance costs. There's some other things investors can do as well, particularly in times like these where we have record low vacancy rates in most parts of Australia. So how much of a difference can these and other measures make? We'll put forward some answers to these questions today, and we'll also provide an update what's happening in markets around Australia. So to achieve all that over the next hour, I'm joined today by Tyron Hyde from Washington Brown. Tyron, welcome.
Thank you. Thanks for inviting me, and thanks all for coming.
Yeah, so I imagine that this is the time of year when things get really busy for Washington Brown, when people are starting to think about things like depreciation schedules and tax returns.
Absolutely, and I guess with people with the media at the moment, telling people property prices are possibly falling and wages stagnating, and people probably want to save that extra dollar, and depreciation is a good way to do that. And also, particularly around now, because you can actually claim our fee this financial year if you organise. So June gets really busy for the quantity surveying industry because everyone wants the tax deduction this year, not next year. So yes, it's a busy time.
Sure, okay. So today we're going to start with a bit of a quick update on what's happening with market, because you did refer to in your comments there to the possibility that prices may be falling in some parts of Australia. So we're going to look at the reality of what is actually happening according to the data. And then we're going to segue from that into talking about some of the things that investor owners can do to offset the impact of rising interest rates, including what people can do with rentals. And then we'll look at a presentation from yourself about how depreciation works and how much of a change that can make to people's bottom lines. So let me just bring up start of our presentation about what's happening across Australia, and I would emphasise that the information I'm going to present is somewhat in contrast to the headlines we're seeing, because pretty much every day now we're seeing headlines telling us that property prices are falling right across Australia. And of course, nothing remotely like that is happening. It's just that curious way in which media feels that it can present headlines and information that are actually quite a significant departure from the actual truth of what's happening. So we'll look at what the data tells us is happening in markets across Australia, and then we'll go from there to talk about some of the specific things as they impact property investors. Feel free, Tyron, to jump in at any point.
It's just funny. You never see a headline in the media that there's a flat, steady growth of 7%. It's always seems to be boom or bust in the media in terms of property.
Yeah, and it's always a crisis. With prices are rising, that's a crisis. If prices are falling, that's also a crisis. So
yes, that's right, exactly.
We're constantly living in a state of crisis. It's a word that's rather overused. But one of the things we will talk about today, which is the rental shortage, I think that is a crisis in this country that's affecting a lot of people and not really getting a lot of attention from political leaders. It wasn't even mentioned in the federal election campaign. But first, let's just have a look at what's happening with prices. This is the latest data from CoreLogic, published on the 1st of June. And it's interesting because CoreLogic's data is what is most often used and quoted in media to justify the headlines that prices are falling right across Australia. Well, the CoreLogic data actually doesn't show that. Here's what it shows in terms of annual growth in the major cities of Australia over the past 12 months, the 12 months to the end of May. And you can see that all of the capital cities are up. But what you can also see is that we are now starting to see quite a high level of segmentation of markets in Australia, whereas it felt throughout 2021 that everywhere was producing exponential growth. What we're seeing now is that we still have some locations like Brisbane and Adelaide where the annual growth in property prices is extremely high. We have some locations like Hobart and Canberra, still very good levels of growth, but not quite at that exponential level. And then there are locations like Melbourne, Perth and Darwin where quite moderate growth has been recorded in the last 12 months. Regional markets have been outperforming capital cities overall for a number of years. We do have that trend that I like to call the exodus to affordable lifestyle, which has been underway in various forms for at least the last 10 years. It's another thing that's been misrepresented by media. They're kind of portrayed it as a response to COVID, when in actual fact this trend has been underway for much longer than that. So as you can see from the figures on the screen, there's very high levels of growth still in many of the regional markets around the country. Regional Tasmania has been strong for 5 years and still is, up 30%. Regional Queensland, South Australia, New South Wales, still very good. Regional Victoria's hanging in there very well. It's been a growth market for 5 years and still is. And overall regions are up 23%. If we just go back to that previous slide, the capital cities, the combined capital cities as an average are up 14% in the last 12 months, whereas the regions are up 23%. If we look at the most recent quarter, that's also quite informative, because again, the headlines are telling us that prices are falling everywhere, and clearly they're not. What we are seeing though is that Sydney and Melbourne, according to the CoreLogic figures, because other figures from other sources disagree, but the CoreLogic figures indicate that prices are now starting to contract a little in Sydney and Melbourne, but that's not happening in other capital cities, and we still see that Brisbane and Adelaide still got very strong markets. So do Darwin and Perth to a lesser degree, but still, if you annualise those figures, those cities are growing at 12 or 15%. And in the case of Brisbane and Adelaide, their growth is still 20-25% if you analyse those quarterly figures. Looking at what's happening in the regions in the last quarter, again, we're seeing very strong levels of growth in all the regional markets across Australia in the latest quarter. That's the 3 months to the end of May, particularly in South Australia and Queensland, but also very good levels of growth still being achieved in the bigger states like New South Wales and Victoria, and Tasmania still continuing to be very much a growth market. So when we look at the monthly figures, which seem to get the most attention by me to what's happened in the month under review, if we divide Australia into 15 market jurisdictions, as CoreLogic does, 8 capital cities, 7 state and regional markets. There's no regions in the ACT, that's why there's only 7. What we find is that in the month of May, 12 of those 15 markets produce price growth during the month. So it's very, very different to the scenario, Tyron, that's being portrayed in the headlines saying the prices are falling every day. And I'm seeing those headlines broadly stating every day prices are falling across Australia. Well, it simply isn't true. And
Interesting. I once wrote an article called 7 Reasons Why I Like Property. And one of the main points of that was because I don't actually want to see the index every day like I can do with my share portfolio. It's much better just to sleep at night, not having to worry about the data every day of it, whether my property's gone up or down each day, because it's limited data. The more narrow the market and the less the time frame, there's not only so many sales, so less accurate when you say if we're getting down to monthlies. I guess in the Sydney region, but in each area, I'd rather not worry about a 1% decline. I kind of like that. Whereas with shares, every day, like Zip went down 20% yesterday. And it can cause a lot more stress than worrying about whether your property is going down 1% per month, in my view.
And I do think there's too much emphasis placed in real estate on month-to-month changes, because what we've noticed over the years that the data might be down 1 month, but then it recovers the next month. It's too short a time frame to get any meaningful impression of what's happening with markets. We need to look at longer term periods of time to get an idea of the real trends. But it's because media is so obsessed with the monthly changes that right now we're in, since the beginning of last year, there have been 5 separate periods in which media has declared the end of the property boom. The first one was about February last year, based on 1 month's data from CoreLogic. And of course, it was contradicted by the next month's data. So they said, oops, we got that wrong, and just carried on regardless. And then again, about May, they declared the end of the boom, only to be contradicted by the data that came out in June. So we're now in another one of those periods saying the boom is over, despite the fact that in 12 of the 15 major market jurisdictions in the country, we actually have seen growth in property prices. But of course, my view is that all real estate data is rubbery figures. It's all dodgy data. to a certain degree. And the question you could reasonably ask, are prices rising or falling? And if so, by how much? Because here we have a comparison of the latest figures from CoreLogic for the month of May, and also the latest figures for the month of May from another credible and reputable source, SQM Research. And they differ a lot. If you go down looking at the figures in the table, we see that whereas CoreLogic says Sydney prices were down 1.1%, SQM says Sydney prices had no change. CoreLogic has a 0.8% rise in Brisbane, whereas SQM Research says 2.2%, which is a much more significant increase. And we have the same scenario for Adelaide.
How can they differ, Terry? I'm curious. How can they differ when they're all looking at the same sales?
Well, that's exactly right. Now, I think consumers might reasonably ask that question. It's very confusing. Well, I think the first reason is they have different methodologies. A second one is that what they're attempting to do is essentially the impossible. You're trying to distill all the sales that happen in Sydney, the Greater Sydney area, with over 700 suburbs as diverse as, say, Campbelltown versus Manly, or Mossman versus Penrith. That's all put into one big melting pot, and they spit out one number saying this is what's happening with Sydney property prices. And it's what they're attempting is ridiculous. When you segment it down, look what's happening sector by sector, you find that in Sydney, probably it's true to say that the top end of the market prices have come back a bit, but in the cheaper areas of Sydney, the more affordable outer ring areas, we're still seeing prices rising. But they've got different methodologies for dealing with all that diversity, and they come up with different numbers. So in the case of Canberra, CoreLogic says that house prices dropped 0.4% in the month of May, whereas SQM Research says they actually rose 2.1%. And then it's flipped around for Darwin, whereas CoreLogic says that Darwin's risen, whereas SQM Research says it's fallen. How do you make sense of all that? Well, you really can't as a consumer. It's just confusing. You just got to be aware that the data differs depending on which source you look at, and you can't place too much blind acceptance on what you see in media as to what's happening with property prices. CoreLogic says as an average across the country, nationally prices fell 0.1%, which is virtually no change, and that figure is dragged down by the weight of Sydney and Melbourne. Whereas SQM Research says property prices actually rose 1.4% in May. Just be aware of that. Don't take the data that's published in media and the emphasis they put on it and the interpretation they put on with a grain of salt, because there are all these differences. And if we could include other sources like Domain, the Bureau of Statistics, realestate.com.au, and they'd all have different numbers for each of the capital cities. So,
yeah, interesting.
It is, but also confusing. But I think it's important for people out there watching and listening to understand that it's not gospel truth. It's mostly CoreLogic data that's published. They tend to emphasise the negative, and it's not necessarily gospel truth. Just be aware of it.
I bought a unit about 20 years ago in the Finger Wharf in Sydney, Woolloomooloo, and it just settled. And I remember after, so a lot of people settled at the same time. Obviously, it's a pretty expensive building, beautiful building. And then the headline on the front page on the Sunday paper was Woolloomooloo goes up 35% in property prices. No one did it. Everyone just settled, and it's raised up property prices.
Right.
It's just because one building settled, which is a luxurious Finger Wharf, right? It didn't go up 30%.
That's right, and that's an example of one of the distortions that can be imposed on median price data. That one major, large, high-profile, expensive building settles, and suddenly the median price for the suburb rises. But it can work in reverse as well. And media tends not to care too much about those niceties. They just want to publish the stark figures, and usually emphasising the negative. There was a headline I saw last week in Canberra where the article was about the 3 suburbs in Canberra where prices had fallen in the latest month, ignoring the more than 100 suburbs in Canberra where prices had actually risen. But that's the mentality that you get from media. Let's turn our attention to an area of property data which where there's probably very little disagreement, and that's in the area of, let me just click there. That's not exactly what I wanted to do. Next slide. Vacancy rates. I don't think there's any disagreement anywhere in Australia that we have extraordinarily low vacancy rates, indeed the lowest ever recorded. And this is a very important information for property investors, also for people who are out there as tenants or wanting to be tenants, because it's become increasingly hard for people to find a rental property at any price in most parts of Australia. And if you can find one, it's a very high price and it's rising because we have this extraordinary level of vacancy. All the capital cities are below 2%, keeping in mind that the industry benchmark for a balanced market has always been 3%. So once you get a vacancy rate below 3%, you're heading towards shortage, undersupply. Once you get below 2%, you've got a serious undersupply. And once you get below 1%, which is where 6 of the 8 capital cities are now, you've got something that does deserve to be described as a crisis. So Hobart and Adelaide, 0.4%. And when you look at some of the individual postcodes within some of these cities, there's one local government area in Adelaide, the city of Onkaparinga, where there's 12 or 13 postcodes in that municipality, and every single one of them has got a vacancy rate of 0.3% or lower. Some of them are zero, which means that there's just virtually nothing available for rental. And you can see from the figures on the right-hand side there, April 2020, April 2021, then 2022, comparing the national average figure at that time, you can see how it's dropped quite dramatically to the point where right now it's around about 1%, and the extended out to regional markets, pretty much all of them have vacancy rates below 1%. Tyron, have you ever seen vacancy rate figures like these at any time in your career?
Never. And I've been property 27 years now. No, it's crazy out there. The major way to fix a vacancy issue is to increase supply. And now, from a quantity surveying point of view, with building prices going exponentially high, it's harder to make sites work and harder to, build a duplex to make it work. So I don't see how the sudden massive increase in supply is going to fix the issue. So how's it going to be fixed? I just can't see the resolution.
Well, there is no resolution in the works because we've just had a federal election where they talk quite a bit about housing affordability, but nobody on either side of politics talked about the rental shortage. They don't even seem to be aware that it exists. Nobody had any policies to deal with it. So from a federal level, nothing's going to be done. We're not hearing or seeing anything at a state government level either. What we have seen in the news today was for the city of Brisbane, the Brisbane City Council, which covers a big chunk of the greater Brisbane area. They're just threatening to massively increase council rates for investor owners who use Airbnb, short-term rentals rather than permanent rentals. They're trying, they say, to encourage investor owners to put their properties into the permanent rental pool rather than the short-term rental pool. I think it's a cash grab. It's not going to fix, it's not going to make a big dent in the rental shortage, but it's an excuse for the Brisbane City Council to increase rates without really dealing with the issue. We're in a situation because we've had 5 or 6 years of decisions by state governments, federal governments, and bureaucracies like APRA, which have discouraged property investors. The only way to fix this is to actually encourage property investors. But we've been doing the opposite for the past 5 or 6 years. And so steadily, gradually, the number of properties out there in the rental pool owned by investors has diminished to the point we have this very serious rental shortage crisis. And what that means, of course, is that we now have strongly rising rentals. In fact, we're getting to the point where we're going to see the rate of growth for rentals to be higher than the rate of growth for sale prices in some parts of Australia anyway. So according to Eskom research, these are the average figures for the last 12 months. In the capital cities, house rents are up 17% and unit rents up 14%. But if we break it down into individual cities, again, according to Eskom research, you can see that Sydney, Brisbane, Melbourne, they've all had house rents rising, according to these figures, by 20% or more.
Wow.
And we've also seen double-digit rises in all the capital cities for houses, and in most cases also for apartments. So rents are on the rise, and
And the applications are as well. I don't know if you saw that show on 7:30 report about a week ago. I think they were in Cairns, and this young family, there was like 300 applications for a standard unit, you know, and they ended up living in a tent. Terrible.
That's right. And what we're seeing quite commonly, and I've experienced it myself as an investor owner, is that when a rental property rather rarely becomes available for rental for whatever reason, and an open house is staged, you get 20, 25, 30 people or parties, couples showing up to the open house wanting to rent that property. And it's become common for people who are in that queue to offer more than the asking rent to try and beat the competition. And that's one of the reasons why we're seeing rents rise so much, that people are actually creating a kind of auction, an unofficial auction, to try and get ahead of the queue when they turn up to an open house and there's so many other people competing for that property. It's a very serious issue for people out there who need to be tenants or choose to be tenants rather than owners. Just further to the figures on the screen, I think you saw this article as well, Tyron, in the Financial Review this morning, saying that apartment rents in inner Melbourne are up 29%.
Oh.
We've seen vacancy rates in inner Melbourne and inner Sydney come down a lot, particularly since international borders were open. We've started to see migrants come back in. We've started to see international students come back in. That factor is going to continue, and it's going to make the vacancy rates even lower, and the pressure on rentals to rise even higher.
Definitely scary.
It is, but this is it's an avenue for investor owners who, if they've recently had their interest rates increased and wondering, well, okay, my costs are going up. Well, in most cases, I mean, it's fair to say that their income is also going up, or has the potential to go up, because of the sort of numbers we're seeing on the screen, and based on these very low vacancy rates, and we're starting to see rental increases of that. But I think it's going to get bigger before it gets smaller. We're actually in a point in the market, whereas according to the CoreLogic figures, prices are starting to contract a little in Sydney and Melbourne, sale prices, but rents are rising at these very, very high levels, which means yields will be rising, which is a way to compensate for the increase in interest rates.
Yeah, definitely. I guess there's two sides of every talk, isn't there, really? But it is, if you're a tenant, it is getting tougher, that's for sure.
So that's one of the methods by which investor owners can compensate in terms of rising interest rates and high monthly mortgage repayments, if that is indeed the case, because I know that there are plenty of people out there with mortgages who actually haven't had their monthly payments increased because they were already paying more than they needed to, because they didn't reduce the repayments during those periods when interest rates were falling. You need to ask the bank to reduce your repayments. A lot of people didn't. So they're already paying more than they need to. So with the interest rate rises, their repayments haven't increased. And then there's also the factor that people who are approaching lenders as new borrowers are actually getting much lower interest rates because they're competing for the new business, and they're actually making cut price interest rates available for new business. So
and a lot of people have fixed rates as well, such as myself on some investment properties. And let me tell you, Terry, I've never won. Whenever I fix my rate, I've always, at the end of the fixed rate, I just wish I went variable. And I don't know what it is that made me think that I could beat a bank when they have floors and floors of people predicting interest rates, and I just thought I know better than them. But I vow I'll never get another fixed rate, but I do, and then I end up losing. So it seems that every time my fixed rate comes to an end, it's I'm just about even, like where it was. So it's like, and I missed the dip down, but that's just me.
Yeah. Well, the banks may be better at predicting the trend with interest rates than they are and predicting property prices. Because they've got a very bad track record.
They have, haven't they, lately?
Yeah, well, forever really, but certainly at the beginning of the COVID period a couple of years ago, all the major banks were forecasting prices to fall quite significantly, and they actually rose.
I remember we had a webinar around that time. We did a webinar. We'll say, they were wrong. Very well.
Indeed, and at the beginning of 2021, they were forecasting price rises, but only very moderate 6, 7, 8% rises. And what we got was 25, 26%. So they got that wrong. And now they're forecasting that prices will fall because interest rates are rising. I think they'll be wrong about that as well. Certainly the downturn we've seen in the various data for Sydney actually was starting to happen late last year, long before we had the interest rate rises. So. Now, the next thing we want to talk about today, Tyron, is, of course, the impact, the positive impact for investors on depreciation. And that's where your particular area of expertise lies. So perhaps you could...
I'll share my screen and I'll take over. It'd be good to talk about some figures that aren't so rubbery, Terry.
Well, that's right. So much of the data in real estate is dodgy data, I think, but the numbers you're about to present are just... something that people can perhaps rely on a little bit more.
Great. Excellent. Well, thanks for that, Terry. It's great. So thanks everyone again for coming. So I'm going to talk about three things really: how to offset rate rises by depreciation, the law changes that occurred in 2017. You're probably aware of it now, but it's probably good just to have a quick recap of it, and 7 crazy depreciation facts regarding these laws that I don't think were thought about when they were introduced, the practicalities of what the changes in the depreciation law and how it affects you as property investors. So let me get into it. So my name's Tyron Hyde. I'm the CEO of Washington Brown. I'm a quantity surveyor. And in summary, what that means is we work out what things cost to build. We prepare depreciation schedules for property investors around the country and in fact around the world. And a depreciation report helps you as property investors save money. And I'll show you how. Before I get into it, I just like to touch on what my story is. So I went to uni. I started uni in 1989. I actually wanted to be an architect, but I didn't get the marks. Then I enrolled in a Bachelor of Construction Economics at UTS. I did that for 2 years, and then I went on a gap year. I actually went on a 3-year gap year to London, like all young Aussies should, I think. And the main thing that taught me was that I didn't want to work for minimum wage. Working for minimum wage in London in the early 90s wasn't much fun. So I came back and actually finished my degree. And at the ripe old age of 24, there was an ad on the wall wanting a cadet, a company called Washington Brown. And because I felt so old at 24, I went and stole all the signs at the uni. So I was the only one that turned up for the interview. And because I felt so old, I offered to volunteer at Washington Brown for free for a year. So I was doing uni on my final year and working for Washington Brown free of charge. And then I ended up owning the company, which is a wonderful thing to occur. But
I gather there's a bit of a gap between those two events there.
You're saying I'm old, Terry. Yeah, there's a little bit of a gap between those two. But yeah. So Washington Brown, we prepared depreciation schedules, not just in Australia. We do it all around the world now. So if you buy an investment property in the UK, you actually claim the depreciation based upon the tax laws here. We do all types of properties, whether there's some, I just came up with some ideas of what we do there. We've depreciated offices, factories, hotels, brothels, car yards, car parks, vineyards, retirement villages, many, many things, not just residential property I'm talking about here. But let me get into what is depreciation. So just like you can claim the wear and tear of a car or a ute or a tradie, or you can claim the computer for your office, you can claim the wear and tear of an investment property against your taxable income. It has to be an investment property. You can't claim depreciation on your owner-occupied property. And it's based upon the actual construction cost of the property. So if you buy a property, say, built in 1990, we have to go back and work out what it costs in 1990 in order for you to claim. It's not based upon what the costs are now, unless it's brand new. If it's secondhand, we work out what it cost when it was new. And the reason I'm sitting here today was that there was a ruling in 1997, just after I wrote my thesis on property depreciation, would you believe, called TR 9725. And what it did, it identified quantity surveyors as being the appropriate body to estimate costs where the costs are unknown. So accountants used to do this, and they worked out, well, hang on, quantity surveyors actually know a lot more about costing, and we know a bit about tax law. So the combination of those two enables us to prepare a report which is accepted by the ATO. And why should you care? Because what we write in a depreciation schedule, you get to claim off your taxable income. So if we say you can claim $10,000 in year one, and you're on 45% tax rate, you end up with a net $4,500 in your hand or tax refund. That's why we do what we do. So there's two types of allowances in terms of depreciation. There's what's called the building allowance, which is the Division 43, and that's the structure of the building. That's the brickwork, concrete, windows, roof. I'm looking around my house at the moment, kitchen, cupboards, stuff that's going to wear and tear longer. And the ATO has determined that that's going to last for 40 years. So your toilet in your house, the ATO says it's going to last for 40 years. And you get to claim that at 2.5% fixed per annum. So if your kitchen was $10,000 when it was brand new, you get to claim $250 for 40 years. If I buy a 20-year-old property, $5,000 has already been depreciated by the previous person. I've got $5,000 left in it, but I still only claim $250 per annum. It's called the prime cost rate. It's fixed. Now, in order to claim this, the property has to be built after 1987. Okay, so if you buy a property that was built in 1984, you can't claim the building allowance. The second part of a depreciation schedule is what's called the plant equipment. This is the stuff that wears and tears quicker. The ovens, the blinds, the dishwashers, the carpet. And it makes sense because, your carpet is going to be replaced. If you don't, I don't want to live in a house that has 40-year-old carpet. And the ovens, generally have a useful life of about 8 years, 10 years. So you can claim those quicker. If the item has an effective life of 10 years, you get 10% per annum on the prime cost. Now, in the good old days, you used to be able to depreciate both the plant equipment and the building allowance, regardless of how old it was. We would go out to any property, whether it be a 50-year-old property or 2-year-old property, and apportion the plant equipment based upon your purchase price, and you'll be able to depreciate that. But the 2017 budget changed that for property investors. They said that they are going to deny income tax deductions for the decline in value of previously used depreciating assets. What does that mean? It simply means you buy a second-hand property now, even if it's 1 day old, you can no longer claim the depreciation of the carpet, blinds, the plant equipment. Even though the government says, even though the tax law says that if it's brand new, you can claim the carpet over 10 years. As of 2017, if you buy a property that's 1 day old, you can no longer claim the carpet, only if it's brand new. It's stupid in my opinion, but that's what they did. Why do they do that? They said that this was an integrity measure to address concerns that some plant equipment items are being depreciated by successive investors in excess of their actual value. And they were right. They were right in that we shouldn't have been able to go to a property and say, okay, it's 50 years old, there's still carpet there, you can apportion the price. There was no set way of how to determine the apportionment of, I'm getting a bit technical here, of the apportionment of the purchase price to plant equipment attached to land. So they just, instead of saying, okay, well, there's a better way, you can, if the carpet's only over 10 years old, you can claim it over 10 years. What they said was, they came in with a sledgehammer and said, bang, the moment it's 1 day old, it's cut off. So let's put that in perspective. If it's second-hand property now, you can no longer claim things like ovens, dishwashers, lights, aircon, television, carpet, all those plant equipment items, okay? And it's not just internal items, it's lifts as well. So if you buy in a strata property and your property is 1 year old, if you buy a property that's 1 year old, you can't claim the common property lifts, even though you own a portion of that. And lifts last 30 years according to the ATO, but not according to what you can claim. The smoke detectors, common property carpet, the garage motor doors. So when they came up with these laws, the ATO, sorry, the Treasury Department invited me in because they knew I knew a bit about this stuff. I'd written a book on this. They asked me what I thought of it. It was a big table as long as Putin's table, if you've seen that. Putin, when he had the table was about as long as Putin's table, and there was only 3 people down there. But I could actually sit near them, unlike Macron, who could not sit near Putin. I could actually sit near them down there at the table. They asked me what I thought of it, and I said, "Look." They looked at me and said, "Well, what we're doing, will it stop people overclaiming depreciation?" I said, "Yes, it will." I said, "But there's a better way than doing this." And I left them all a copy of my book, and I told them there was a better way. And the better way was simple. I said, "Look, if someone was to buy a brand new a property that's say 5 years old." When it was brand new, let's say carpet, when it was brand new, it had an opening value of $3,000. So the developer put carpet in there for $3,000. If it was sold after 5 years, well, the value was $1,500 left, right? But if you were to purchase it after 12 years, because carpet has, as I say, a 10-year effective life, well, there's no value left. So all I was arguing was just to use the effective life that the ATO has published as to when you can stop the claim. Quite simple. If an oven has an 8-year effective life and it's 4 years, someone buys a property that's 4 years old, well, there's 4 years to go. Same way that we deal with the building allowance. But no, they just went bang, stopped it straight up. So it creates some problems, as I'll run through later. So a quick recap of what they did. New property. So there's been no changes to new property. So if you were to buy a brand new property today, you can still claim the depreciation on the plant equipment and on the building allowance, which kind of puts new property as, I don't encourage, I'm not advised to say whether buy new, second-hand, whatever, but from a purely mathematical point of view, new property can actually look technically better on a cost per week ownership basis because of the depreciation benefits. What else did they do? Well, they didn't change the laws for offices and industrial. They left it the same. And I was arguing, well, if the system is broken in residential, but it's the same laws, why is it not broken in an office or industrial property? You see, we can still go to a 20-year-old office and depreciate the carpet, but I can't go to a one-day-old residential property and depreciate it, even though they're both investment properties. I thought that was a bit strange. They still said that you can claim bricks, etc. So there was no changes to the structure of the building. They didn't change the laws in that at all. And that's a good thing because that represents about 85% of the cost. So we're only talking about between 10 to 15% of a construction of a property in terms of what the Treasury Department changed. So if its property is 20 years old, you can still claim the 20-year residual value of the structure of the building, just not the 5 years or any second-hand plant item. What about if you buy something? What about if I own an older house and I buy a brand new oven and put it in, okay, in an old house? Yes, you can still claim that, but you can't go to Gumtree and buy a 1-year-old oven and put it in. So even though you buy it, you can't claim it. It has to be brand new. You have to pay the GST on that item, okay? That's the difference. That's the determination of whether it's considered brand new for the taxpayer. Entity changes. Well, this only relates to residential property investors. Companies, super funds, not your normal self-managed super fund, but a large super fund with 300 members, like an Oz Super or a large trust with 300 plus members, there's no changes. So Macquarie Bank could buy, I always pick on Macquarie Bank when I say this, or Oz Super, they could package up 5,000 houses that are second-hand, put into a fund, and you'll still be able to claim the depreciation on those residential properties. But you or I can't buy a single house in our own personal name or in a self-managed super fund, which I found a bit odd. Grandfather, the good news was that they didn't, if you'd already purchased the property prior, there was no changes. So they let you do that. We had a lot of nervous calls by people that had exchanged on the property but hadn't settled yet. They wanted to know where they stood on this. And it was based upon when the contracts were exchanged, not when you were settled. There was a few.
So you mean time prior to the changes being made?
Prior to the changes, yeah. So they bought the day before the budget, exchanged the day before. They were still in the old system. They bought day after, exchanged. They were on the new system. There was actually a timing on it. We had one client because I think it was at 7 p.m. on this day, and they had to get solicitors' letters saying yes, they exchanged at 4 p.m. That day. It's definite time cutoff period. There was no changes to overseas properties. The build date has to be built in 1990 in order for you to claim the building allowance. But the plant equipment still changed, but there was no changes whether it was overseas or Australian. What about if you renovate? Yes, so if you renovate a property, you can still claim the depreciation exactly as you can now, before the budget. In that, if you buy ovens or put into your kitchen, you can still depreciate that again, but it has to be brand new. It has to be brand new if it's an oven or dishwasher or plant equipment items. So what does this mean in terms of the depreciation? Well, I'll just show you quickly some numbers here. So if it was a brand new unit bought for $850 for a brand new unit, there's no changes. Before the budget, you could still get $20,000 in year one. and $135,000 roughly. These are round numbers. $135 over 10 years. Post budget, because as I said, there's no changes to brand new properties. You'll be able to get $20,000 in year one and $10,000 in year. And 135 over the first 10 years. Where it starts to change is you start buying second-hand properties. Prior to the budget, in year one, you would get $15,000 and a total savings of $95 over the first 10 years. After the budget, you're only going to get $6,000, not only, but you get about $6,100 per annum for 10 years. What's the difference? The difference is the plant and equipment. The first, that not $8,900 in the year one, that would be the depreciation that you used to be able to do on ovens and dishwashers and carpets, etc. Now, all you're claiming is the $6,100. That's the structure of the building, the building allowance. That's the difference here. So after about year, as you can see, prior to the budget, once you get to about year 8, you've pretty much written off all the plant and equipment anyway. So you just claim the structure of the building. So it's a bit, but the thing is here, it's a big difference in the first couple of years, when most property investors need that before the rents start catching up to, what your interest component might be. So it was a bit of a kick in the guts for a lot of property investors. Now, if a property was built prior to 1986, I don't know if you remember, but I said, if it's property was built before 1987, you can't claim the structure of the building. So prior to the budget, you would be able to get some depreciation on the ovens, the dishwashers, even though it's an older property, maybe $17,000 in the first 10 years. Now, after budget, zero, because you can't claim the second-hand plant equipment. And because the property is built before 1987, you can't claim any structural component. Now, that's pretty rare as a purchaser, because most properties that people are renting out that are built before 1987 have some structural, they've been renovated, and there's still some kind of allowances are left to claim. So that's a pretty rare scenario that a client comes to us, but we can't find them any deductions at all. Now, these slides are new, and I put them in here yesterday. So I want you to focus, because there's some numbers, a lot of numbers here. But what I want to show you on the next on the next slide is the difference between if claiming depreciation, how this actually works as a property investor, claiming depreciation and not claiming it, and also how the tax rate influences how much you can save by using depreciation. So I've given you 3 scenarios here. Let me run through them. They're all based upon a $750,000 purchase price and a brand new property. Okay, so let's run through scenario 1. I've said that for this scenario, so what I'm trying to work out is how much the property is going to cost you. The bottom line of each of these 3 columns is what the property is going to cost you. And there's only just a couple of little things changed here. The things that have stayed constant are the rent. I've said on a $750,000 per week purchase price, you'll get $550 per week rent. As you can see, the top row is all $28,000. So on a brand new property in scenario 1, I've moved your interest rate up to 5%, which is where it could go, not the 2 or 3% that we've been paying, but if it goes to 5%. So that would be $30,000 in interest that you'll be paying. I've allowed for other expenses of $11,250. So how much I have, so based upon that, I've got to spend a little bit of, my cash out is $12,500. That means I'm paying $12,500 per annum to own that property. I've got a tax loss because I'm paying it out, negative gearing. I can claim, I've got a tax loss of $12,650. If I'm on a tax rate of 37%, because I've got that tax loss, I get a check back of $4,681 from the ATO. Hope you're following so far. So my annual cost would be negative $12,650 plus $461 because I've got the tax back. So I've actually got to outlay $7,970. So it's costing me $153 in scenario 1. Hope that you can follow that. Scenario 2, same property, exactly the same thing. Rent is $28,000. I'm paying $30,000 in interest. I've got $11,000 in other expenses. That might be your rates, your levies, etc. So I've still got to spend $12,500. But in this scenario, because the property is brand new, I can claim $5,000 in the building structural allowance and $10,000 in depreciation. So my tax loss goes up because that's claimed as a loss, right? Even though it's within the building. Scenario one, the person forgot to claim it. Bit silly. Scenario two, they did claim it. So I've now got a $27,000 loss, right? At 37%, I get a tax check back from the ATO of 10 grand because my loss is $27,000. So my annual cost, because I've paid out $12,000. I've seen it. I've paid out 12 grand physically, but now I've got a tax refund here of 10 grand. So my actual cost out of my pocket is $2,400. Divide that by 52, and I'm only spending $46 per week to own the property, as opposed to $153 when I don't claim depreciation. That's how it works. So these costs here, these depreciation, they're what called non-cash deductions, i.e., I don't physically pay them out because they're already within the property when I buy it. All it does is creates a bigger tax loss for property investors, and I get a bigger tax refund, which is then offset by my physical cash outlay. I hope you follow that. So therefore, my actual cash outlay is only $46 per week. I might just move this little thing over here. So the third scenario, it's the same thing as scenario two. Again, we've got the same rent, same interest, other expenses are the same. So my cash outlay, I'm paying 12 grand. I'm claiming the same depreciation. So I've got the same tax loss. But in this scenario, the final scenario, I'm on a higher tax rate. I'm on the highest marginal tax rate. So instead of getting a tax check back from the government of $10,231 in this column, I now get a bigger tax check back because I'm on a 45% tax rate. So the higher the tax deduction, the more impact it has for me when I claim that as a tax loss. Make sense? So I get a $12,000, $443 tax check back from the ATO. So my annual cost is only $200, which is the $12,650 less my tax refund. So I'm only paying out $208 per annum. So which is $3 per week. So by claiming, you can see by claiming the depreciation makes a massive difference, and it does work better if you're on a higher tax rate. But claiming the depreciation is the most important thing. And if you're not claiming depreciation, well, you should in 99% of cases, and that will help you offset any interest rate increases that may occur. Yeah, so something to ponder. But I thought this gives a good indication of how it actually works in terms of claim depreciation and also the tax refund component. I know there's a lot of numbers there, but Philip.
And I imagine, Tyron, that there are scenarios in which without depreciation claim, you're actually negatively geared. You're having to dip into your own pocket every week, but using depreciation will turn it into a positive cash flow property.
Absolutely. So this is on at 5%. So at the moment, when with interest rates at 3%, it'd be very hard using these numbers to be negative geared, which is funny, I find, because, you know, if you remember 5 or 6 years ago, negative gearing was the pure reason that property prices were going through the roof and they wanted to squash it. But that didn't actually turn out that way because people are being positively geared, and it still seemed to property prices. And there's not so much. There wasn't so many calls of squashing negative gearing when a lot of people were positively geared. So I don't think that was the pure problem of why property prices have gone up. I think it's obviously probably got to do more with supply of land than whether people were negative gearing. But in fact, they've actually positively geared and actually paying money out to be a property investor. 7 crazy facts about these new laws. So when they did this, I don't think it was very rushed. The Treasury Department when they called me and they said they're going to have industry consultation, which meant we've already made up our mind on what we're going to do. And they did what they were going to do. But where this gets interesting, so as I've said, if you buy a property that's 1 day old, you can't claim the depreciation now on it. But where it gets even more silly is if you were to buy a property off the plan and you had a dual settlement with the, if I was to buy a property off the plan and I sell it to you, Terry, before settlement has occurred, so I flick it to you before settlement, we're both going to settle on the same day. I will settle off the developer, you and then I will settle on the same day. Now, because you didn't buy it off the developer and you didn't pay GST on it because you bought it off me as a second-hand property, even though you have neither I or you have ever been into the property, it's considered second-hand. The property's never been opened. It's considered second-hand, and no one can claim depreciation on the plant equipment, even though it's, or for all intents and purposes, it's brand new because you didn't settle off the developer. So that's a trick, or not a trick, but a tip for people that are buying off the plan. Make sure or check that the name of the vendor's name is a PTY Limited or the company, not John Smith, because if it's John Smith and you think you're buying it brand new, you might get an ugly surprise when it comes to claiming the depreciation because you won't be able to claim it. And maybe the sales agent probably wouldn't know that, and he'll be selling you it's brand new because no one's bought it. So you'll be in your head, you'll be thinking, oh, this is brand new, I still get to claim depreciation. Something to think about. I thought it was crazy stuff. Number two, I thought it was bizarre, as I said before, that residential property wasn't it was picked on, but there was no changes to industrial commercial. And I think that had to do with the fact that the property council were powerful and lobbied. But so, I could still, as I said before, buy a 50-year-old industrial factory and still claim exactly the same way as before. So I don't know why that occurred. Now, here's what's interesting. So as I said, commercial and residential won't change. Sorry, commercial, industrial, retail, anything non-residential, there's no changes. And residential has. But what happens where you buy a property like this type of property, where you've got retail down the bottom that leads up the stairs to a residential property? Well, in this scenario, the property is 1 year old and the tiling goes, or the floorboards go from the retail shop up the stairwell, up into the living area of the upstairs residential property. We can claim the flooring that's on the ground level, but not the flooring on the top level, even though they're joined, but one's residential, one's commercial, which is kind of bizarre. You could have air conditioning that goes through the bottom section, then up through the top section, but it can only claim the air conditioning on the ground floor, not on the upstairs, even though they're the same building. Very bizarre. Now, air conditioning is, we have to now split air conditioning into 7 different components, being the main components of ductwork, and then there's 7 bits of moving parts that come with air conditioning, whether it be the controls, the chillers, etc. So now if I was to buy a brand new property, I would be able to claim all those 7 items: the ductwork, the chillers, the controls, etc. But when I sell it to you, Terry, you moving forward can still claim the ductwork because it's part of the building going to the ATO, but you can't claim the controls that turn it on. Bit bizarre.
I don't think it's meant to make sense to the average consumer.
Fair enough. Bigger is better. So, yeah, I was a little bit concerned as to why can I not claim depreciation in my personal super fund if I buy a residential property, but Oz Super could buy 300 properties and claim that. I thought that was a bit unfair. And one of the last notes, so an example of bizarreness with these laws is if I was to have this happened to me recently. I had a property in Bondi Junction. I did a renovation like a lot of people do in order to dress it, to sell it up. You do the makeover of the carpets, the blinds, the ovens, the dishwashers, stuff like that. And then when I go to sell it, even though the tenancy had ended, so it was vacant, you've got a month to do a bit of an internal reno. I go to sell it because but the actual structures was built in the 1990s, but all that oven and the dishwasher has never been used. When you buy that off me, you can't claim those items, even though the oven's never been turned on, because you didn't pay GST on it. It wasn't sold as new stock, even though it might have looked, all those items were brand new. I could even give you the manuals, I could even give you the warranties, etc., but I wouldn't be able to claim them. The final thing is, the last crazy stuff, number 7, was I would argue that there's still some firms saying that every property needs to be inspected. Now, we review each property before we advise clients on whether they need to have the property inspected, because a lot of the top cases, because you can only claim the structure of the building now, we have a lot of the costs. We've been working for companies like Meriton for 27 years. We have the actual costs and plans and structural plans, etc., on thousands of buildings around Australia. So, in my view, if you are going to order a depreciation schedule, make sure that in your interest to pay the extra additional bit for the inspection. We still inspect about 30% of properties. We just make sure that it is in their interest to do that, whether it be an unusual property, whether there's been renovations, etc. But if you were to buy a one-bedroom unit that hasn't been renovated in Sydney, and it's 10 years old and we've already got the costs, well, there's no point us charging you extra to give you the actual cost. So my one bit of tip of advice was to make sure that you are paying for what you need to pay for. And that's pretty much, oh no, sorry, there's one little bit more sleeves, just a little bit of a funny story at the end here. So when I wrote my book, Claim It, this is the first edition, took it on world tour. I was doing a marathon in New York actually, and I took it on the world tour. And I want to get a photo around some funny places. And I got a photo here at Wall Street because I thought, well, Wall Street, they've been claiming it for years and getting away with it. Why can't we? And then I took it to Disneyland, and that's my daughter there with a Disney princess. And as you can see, I don't know if you've been to Disneyland, Terry, but they take you from booth to booth with the princesses, right? You got one princess there, one princess there, one princess. And I got wanted a photo with this lovely princess, and you can see the body language there. Oh no, don't do that! You can't take a photo. And I was like, it's a book about tax depreciation in Australia. I don't think I'm really going to monetize this, right? I was so protective of their brand, right? So the next booth we went around, that's my daughter there. Next booth we went around. You can see my book, my hand behind my back there, because they had security guards, 3 security guards that rushed around and told me to put that book down. And I had to take the book in it because I couldn't monetize it. So that's why my hand is behind the book. Because really what I want to do, put something on social media, something along the lines of, once upon a time there was a Disney princess. She read Claim It and she lived happily ever after. But unfortunately, Disney put a stop to that. And my final thing to say is it's a great time to order a depreciation report. And if you do need one, you can claim our fee this financial year, even though the report might not be completed. We can issue with a invoice this financial year, and you can claim our fee this year. If you were to email sales at Washington Brown, if you need a report with the subject line Terry Ryder, we'll give you a 10% discount on any fee as a thank you for coming today and listening to myself and Terry. So I was wondering, are we going to go through to questions? But thanks again for listening.
Yes, Tyron, I think we can have a quick look at some of the questions that are there. We're all at 1:27, so we don't have a lot of time, but we maybe go a few minutes over. Vinale is asking for an opinion on how interest rates will go. I absolutely have no idea and wouldn't even hazard a guess. I don't think the Reserve Bank even knows. But do you have a view on that, Tyron?
Well, my view is that if Philip Lowe said not long ago that rates wouldn't be touching rates 2024, I don't hazard a guess. All I can do is that I looked at it today, literally, that the Commonwealth Bank had, I could get 5 years, I think they're about 5%. So I'm hoping that will be the max of it. I don't think they're going to explode if that's what they're forecasting. I don't think they've ever been that. Like, I can't see 10% or something. I don't know. Look, I don't know. I've always been wrong. It's in terms of property advice, it is the worst advice I've ever given, is trying to predict interest rates. People ring me out, I'm out. I'm tapping out here on interest rates. Sorry.
Yeah, I think it's pretty hazard. There's some things I'm willing to forecast, but not what they're going to do with interest rates. As I said a couple of months ago, the Reserve Bank seemed to be of the view that it wouldn't be lifting the official rate any time this year, and then they suddenly changed their mind. So if they don't know, what chance do we have? Look, Normie's says you're great, and he's put in a question there, which is, to my mind, can you see that in the Q&A panel?
No. Okay. No. Okay. No, I didn't see this. Okay, I'm glad I didn't, because it would have been distracted. But it's good now. I can see it.
So Normie's got a question there about houses of multiple occupancy, which may be a little bit difficult to deal with in 30 seconds today, but
well, there's no difference really. I'm just reading it here. That I'll read it out. In the HMO, houses of multiple occupancy space, in regards to a co-living product, what are the depreciation benefits for investors? Heaps. We're doing it. We actually had a conference call with some of the sales staff today, because we're getting this a lot. So on a new build investment, and you can claim the depreciation just like you can on residential property. In terms of, I said that if you were furnishing it, your question is in regard to furnishing. They purchased brand new. put in houses for tenants and beds. Yes, all that stuff is highly depreciable, just as long as it's new. But it's definitely highly depreciable stuff. All those we can write a lot of that stuff off, like bedding and linen can be written off at 100%. So they're definitely highly depreciable assets, multi-occupancy. The reason why is sometimes you have a lot of individual furnishings in them. So individual beds and all that plant equipment stuff highly depreciates. And sometimes they have little stoves in them, little cooktops, everything like that. Generally, one tip would be, okay, here's one tip for you. If you're going to buy something, you're going to buy a little cooktop stove, make sure it's under $300 as opposed to $305. The reason I say that is because we can treat that as an individual item under $300 and you'll get 100% write-off for it. Okay, so if you're going to Harvey Norman, you've got two options there of a microwave oven that's $295 and one's $305. Buy the $295 one. I don't think your tenant will care, but you'll get a lot of a kick, a lot of deduction straight up front.
Okay. Dilip, Brendan, and a whole heap of other people are all raising the issue. Is it not true that if you sell the property, you've got to give some of the benefits back?
Yep, absolutely. So everyone always asks this question. I was having a seminar once, and someone put the hand up and asked that question. And the guy giving me a seminar, the guy who was having the seminar with me said, "I've got a quick fix for that. Don't sell your property." But of course, not everyone can do that. So how it works is, yes, you have to put back the depreciation of the capital allowances back into your capital gains tax equation. However, you get to claim the depreciation from the beginning. Okay, so if you're claiming $10,000 per annum and you're on the highest marginal tax rate, you're claiming $5,000 per annum on the way through. And $1 today is better than $1 tomorrow. Okay, so that's point number one. Point number two is when you factor it back, as long as you've held it for more than a year, your capital gains tax gets halved. So if you're claiming $5,000 today, when you're selling it, you're paying back $2,500. So you get the benefit that way, right? But that might be in 10 years' time. You might not able to sell the property. So why you wouldn't claim it is not is kind of not that relevant. A good accountant's going to tell you to claim the building allowance and depreciation on the way through.
Yeah, okay, so still worth doing, absolutely. Even though if and when you do sell, there is a little bit of a bite there.
Yeah.
Okay. Yeah, a lot of the questions actually.
Aren't they? They're all the same.
That referring to that that question. I'm saying it's a second-hand house, not even a brick structure and built before 1980, have no tax depreciation at all.
Where's that? Sorry, I can't see that one.
That's actually in the chat box. There's two ways that people can.
Right.
Yeah. Yaron Gal. So a second-hand house that's not of a brick structure and built before 1980 has no tax depreciation at all. Is that what you're saying?
Pretty much, yes. Unless it's been renovated. Something built before 87 has to, unless it's been renovated, you won't be able to claim the structure of the building at all.
Yeah. So I mean, one of the properties I own, it was built well before 1987. It's certainly not brick in structure. But what I can claim is if I put in a new hot water system, new air conditioning units, etc., those are depreciable items.
Correct. And also, this has nothing to do with repairs as well. So if you're repairing items, if you get that plumber out, instead of replacing that hot water system, if you get a plumber out to fix it, that's considered repairs, and you'll be able to claim that as 100%, not get a quantity surveyor to give you a report saying, okay, I spent $150 on the plumber. You'll just give that repair cost to your account.
Okay, all right. Look, we should probably wrap it up. Tyron, we've gone a little bit over time, but what I would urge people to do is to make contact with Washington Brown. If you've got questions on this topic, follow the information on the screen, sales@washingtonbrown.com.au. Is that the best way people have got further questions or wish to follow up in any way or take advantage of that 10% discount on a depreciation report? I I think the bottom line it really is the cost of the report is a fraction of the benefits that you can derive
That's right.
from making those claims. And there was an article in the Australian, I would point out, just in finishing earlier this week, which said that analysis of Australian Taxation Office depreciation data and client deductions suggests that 3/4 of investors don't make the most of depreciation and leave deductions on the table. Do you agree that's the case, that 3/4 of people with investment properties don't really get the maximum benefit? I've seen that figure.
Yeah, I think that's a bit of a rubbery figure if you ask me. It sounds like a marketing spiel from a competing quantity surveying firm, but I certainly would say that a lot of people don't. But I don't know if it's 3/4. That seems very highly unlikely to me.
Yeah. All right. Okay, let's wrap it up. Thanks a lot, Tyron, for the very informative and entertaining presentation on all the reasons that an investor might want to make the small effort of contacting your firm and getting a depreciation schedule. All it takes is an email or a phone call. You do all the work and put it all together, a small fee, and there are many thousands of dollars in benefits that can derive from that.
Excellent.
So thanks for your presentation, and thanks everyone for your participation today and your questions. And if you wish to follow up, please do so by making contact through sales@washingtonbrown.com.au. Let's do it again later in the year, Tyron.
Sure. No worries. Excellent.
Okay.
Thank you. Thanks everyone for coming.
All right. Bye-bye.
Okay, good night. Bye.